The global financial landscape shifted tectonically on the morning of January 23rd, though few realized the magnitude of the earthquake until it was too late. While the Western world slept an emergency directive from President Trump leveraging Section 232 formally categorized silver as a critical vulnerability to national defense, the catalyst, Beijing has effectively severed the artery supplying 70% of the planet's refined silver. As we talk, the spot price is tearing through resistance levels, eclipsing $98 and charging toward triple digits. But focusing on the ticker symbol is a fatal error. The terrifying reality isn't the cost, it's the scarcity. Your neighborhood bullion shop is likely already barren. We have entered a new era where price is irrelevant and the only metric that matters is physical possession before the gates slam shut permanently. Back on January 14th, a presidential proclamation was signed that barely registered in the mainstream news cycle. Yet historians will likely look back on it as the pivot point for the American economy by invoking the Trade Expansion Act. The administration placed silver on the same strategic pedestal as uranium. This is about jewelry or heirlooms anymore. The white metal is now legally defined as essential to the survival of the republic. The chaos that ensued over the subsequent 96 hours perfectly encapsulates the current state of the secret history of currencies. By January 18th, a mere 4 days after the ink dried in the Oval Office, the retail market fractured. APMEX, the heavyweight champion of American precious metals, took a step never seen in its 3 decades of operation. They erected a paywall demanding a $500 minimum purchase for any silver product. Competitors like JM Bullion and SD Bullion mirrored the move almost instantly. We aren't talking about small-town pawn shops trying to manage a busy weekend. These are the logistical titans of the industry moving massive volume, and they essentially signaled that unless you are bringing significant capital, you are no longer welcome in the market. Consider the implications. In a healthy functioning economy, stores don't turn away customers or set arbitrary barriers to entry. That behavior is reserved for moments of systemic failure where inventory is evaporating faster than it can be replaced. Data from the Silver Institute confirms the panic. Physical demand skyrocketed by 400%. In the opening weeks of January, domestic mints are operating their machinery to the breaking point, running nonstop, yet they cannot fulfill even 25% of the current order flow. If you want a fresh American silver, Eagle, prepare for a 2-month delay, and that's assuming your order isn't canceled outright. This brings us to the core of the crisis, a narrative we track closely here at the Secret History of Currencies. Trump's proclamation wasn't a random political maneuver. It was a forced reaction to a supply chain that has been weaponized. While the ore is dug out of the earth in Peru and Mexico, the refining capacity, the ability to turn raw rock into usable bars and industrial components, is overwhelmingly concentrated. In China, we allowed our entire industrial base to become dependent on a single choke point, and on New Year's Day, Beijing tightened the noose under the guise of a new export licensing system. China has halted the free flow of silver to the West. What was once a seamless transaction is now a bureaucratic nightmare, with shipments requiring government approvals that simply aren't being granted. American refineries that rely on imported silver grain to strike coins or supply industry are staring at empty loading docks. Industry insiders have dubbed this the January trap. It was a meticulously timed ambush, executed right as Q1 demand historically peaks. Beijing knew the Section 232 designation was looming, so they locked the vault doors before Washington could even assess the inventory. The administration's January 14th response was an admission of this vulnerability. The document lays it out in stark terms. Without Chinese refined silver, our defense capabilities are compromised. We need this metal for ballistic missile guidance systems, for the microchips driving the AI revolution, and for the solar arrays essential to our energy grid. We are facing a scenario where our military readiness and technological future are held hostage by a supply chain we do not control. This is no longer a market fluctuation, it is a national security emergency. Crucially, the government's acknowledgement of the crisis broke the psychology of the market. Institutional players who were previously comfortable holding paper silver futures contracts suddenly realized that those contracts might be unredeemable. Within 3 days, the premium to buy real hold-in-your-hand silver detached completely from the spot price, jumping to $10 over spot or more. This divergence is the smoke signal of a broken market. We saw a glimpse of this in the lockdowns of 2020, but that was a logistical pause. This is different. This is a structural amputation of the supply line. The dealers enforcing minimums aren't gouging, they are rationing survival. They are refusing to deplete their limited stock on small players because demand is outstripping supply by a factor of 4 to 1. The U.S. Mint's own numbers paint a bleak picture: 12 million coins ordered in 20 days, against a production capacity that can't possibly keep up. This isn't isolated to the U.S. From Tokyo to Toronto, the story is identical. The January trap has snared the entire Western alliance. We are witnessing the bifurcation of reality, the digital illusion of the paper market versus the tangible scarcity of the physical world. The spread between these two realities is widening by the hour, signaling the onset of a physical default. This occurs when the paper promises exceed the available atoms of metal. If you hold a contract for 1,000 ounces but the vault is empty, what do you actually own? The data supporting this is undeniable. In 1 week alone, registered inventory at the COMEX metal actually available for delivery plummeted by 26%. That's over 33 million ounces drained from the system by traders who demanded possession immediately. The free float of silver in New York is evaporating. Meanwhile, the real signal is flashing red in Shanghai, where physical silver commands a $9 premium over the New York price. This arbitrage gap should be impossible in a free market, but because the export doors are welded shut, the metal flows east and stays there. Western industry is beginning to cannibalize itself to survive. Solar manufacturers and EV giants like Tesla and Ford are fighting for scraps. The AI sector, building massive data centers, has joined the fray, adding a new voracious consumer to a starving market. Private mints have seen production collapse by half, not for lack of buyers, but for lack of raw material. They are bidding 40% above wholesale just to find silver grain and coming up empty. This is a calculated geopolitical siege. China is leveraging its dominance in refining, just as it does with rare earths, to squeeze Western economies. The draining of COMEX vaults and the paralysis of Western mints are symptoms of this singular strategy. Smart money has already deciphered the play. The massive withdrawals from COMEX aren't panic sales, they are strategic acquisitions by family offices and high-net-worth entities moving into the unobtainium phase. They know that soon the price on the screen will be a fiction, and the only thing that will matter is physical ownership. Let's look at the cold mathematics. Goldman Sachs has revised their gold target to $5,400. Even if the gold-to-silver ratio remains at its current 501, that implies silver at $108. But in a shortage, that ratio compresses at 401. Silver hits $135. At $251, a level seen in previous crises, we are looking at $216 an ounce. But again, these are just numbers on a screen. If you cannot acquire the metal, the commercial shorts are trapped. They are naked, owing metal they don't possess and cannot buy. When they rush to cover it, will trigger a squeeze of biblical proportions. The U.S. government sees this, which is why the Section 232 order lays the groundwork for the Defense Production Act. If invoked, Washington could seize domestic silver output for military use, leaving the private investor with absolutely zero access. We are entering a period where silver becomes unobtainium. The dealer minimums are just the first wall going up. The secondary market is already seeing premiums of $20 or $30 over spot. The wealthy are buying in bulk, draining the last reservoirs of liquidity, the window to exchange fiat currency for real metal is shutting, perhaps in a matter of weeks. The question isn't whether the price will rise. The mathematics of supply and demand guarantee that. The question is whether you can get through the door before it locks. The U.S. Mint is discussing rationing. Refining capacity takes a decade to build. The shortages are here to stay. History is being written in real time and at the secret history of currencies. Our mandate is to ensure you aren't left holding empty promises. The divergence between paper and physical is the final warning bell. When the music stops, the paper market will be a ghost town, and the physical metal will be in the hands of those who acted while the masses were asleep. Goldman predicts a golden age for precious metals, but a chart cannot shield your wealth. Only metal in your safe can do that. Do not wait for the headlines to catch up. Subscribe now, because by the time the news anchor tells you there's a shortage, the shelves will be bare. Tell me below, are you already holding? Or has the window already closed on you?